Let's get into some technical analysis. These are the things that are important in foreign exchange. These are the things that are important in foreign exchange. Chart patterns, okay? The shape of activity of price is one of the most important things in the Forex markets. And we're going to talk to you and show you clearly what chart patterns are important and what is not important. Trend lines are important. When we talked about we never trade against the trend in the Forex markets, we're going to go through how to establish a trend, what a trend is. For those of you who've traded before, go, oh my God, we're not going to look at what a trend is. It's pretty basic. Yeah, it is basic. Most people screw this bit up. How do we establish what is an uptrend, what is a downtrend? There's a few simple rules, and if they're ignored, it completely screws up the angle of the trend. And if you screw up the angle of the trend, it can be a big difference when we're looking at the Forex market. So we want to make sure we get that part right. MACD divergence tells us when things are going to continue or when things are going to change. It's a very important signal to be aware of, and is the saving grace of many a Forex trader who has not yet learnt it. We're going to use the moving average envelopes, which you don't know what they are yet, but don't worry, you will. We're going to show you how to integrate Fibonacci, and then we're going to show you how to use pivot points. And altogether, they are the main tools that we are going to use in trading the Forex markets. They are the most powerful tools in the Forex market. It's what the big dogs use. It's what professional traders use. So therefore, it is what you're going to use. Yes, we are going to use. Good. Okay, so first of all, basic as you like, a bar. A bar on a chart looks like this. 4 elements: high, close, open, low. And I use bar charts. You can use candlesticks. It's up to you. I've always traded using bar charts, which look like this. They look little bars. Candles look like this, right, like that. Or they look like this. It's whatever you prefer. It's the same data, okay? It's the same data. You just got to understand, whatever you prefer looking at. I prefer myself to look at bar charts because I always have done. A lot of Americans now like to use candlesticks. Europeans tend to use bar charts. And this part of the world, I think it's kind of a bit of a mixed bag. Some people here use candlesticks and some people here use bar charts. I know that a lot of the Asian countries use obviously bar charts because they're Japanese candlesticks. But whatever it is, it's whatever your preference is, whatever makes sense to you. Does that make sense? I'm a bar chart person, so I go for bars. So we've got open, high, low, and that's what an OHLC bar is. You'll therefore notice that all of the charts in the manual you've got are going to be in this format, OHLC, open, high, low, close. You can see certainly here that this particular bar closed higher than it opened, and we would therefore call this a buyer bar. So just to get some nomenclature going here, a buyer bar is where the close is higher than the open. A seller bar is where the close is lower than the open. Does that make sense? Simple as that. We can have a bullish seller bar, and we can have a bearish buyer bar. What does that mean? Well, the terms bullish and bearish should suggest what's going to happen next. Write that down. The terms bullish and bearish suggest what's going to happen next. The term buyer and seller bar refer to what's already happened, and that's an important distinction. So if I say this is a bearish looking bar, it means I expect the market to fall next. Does that make sense? If I say this is a bullish looking bar, it means I expect the market to rise next. I'll show you that in an example in a second. Okay? Okay, let's do some simple stuff. But it's some very important stuff. The first thing we do as Forex traders is we make sure that we are crystal clear. We make sure that we are crystal clear on the direction of that trend. That is important. So the way we do that, let's say, for example, we're looking at a chart here of the euro sterling, which is a cross currency. You'll notice that we have both currency symbols on the chart simultaneously. You'll notice a daily chart because it's got a D. And you'll notice here that I've said for uptrends, we connect the lower troughs. So notice here that we have connected the lower troughs, and all we do then simply is draw a line through them. Why do we draw a line through the troughs and not the peaks? I wonder. No. Why do we care about where it bounces? Yeah, that's right. We care about the trend on an uptrend being across the troughs because ultimately when that's broken, it's going to be broken down here, isn't it? In other words, we care about establishing the uptrend line because we care when this finally breaks through this and then we know the trend has changed. Does that make sense? We don't care about what's happening up here. I mean, this means nothing. You know, we know it's going up. We want to know when it's going back down again. That's why in uptrend we always put the line through the troughs. Does that follow? Yeah. And we want to make sure that we've got 3 in a line, and if we have, we should draw a line through. That's how we tell. That's how we tell. All we do. So what are we doing? We connect 3 troughs together, draw a line through. That's our trend. There are many different ways people draw lines through trends and create trends. They're all wrong, bar this way. Does that make sense? This is the only way to do it. Okay, it's the only way professional traders do it. That's the only way analytical software does it. Is we draw the line through the troughs. That's what we know what we're doing. A downtrend is the same. We look for, you know, where the lines are, where the touches are, and that's our downtrend. And then we look at when it's broken through to the upside, and we know, of course, this is where our trend is. We must be able to identify 3 touches. When we've got that, we've got an uptrend, we've got a downtrend, and we are good to go. Make sense? Good. Notice in this diagram here that there is no trend. It's just an oscillation. Look, I would say to people, what have we got here, an uptrend or a downtrend? People say, oh, I don't know, I think it's probably a bit of an uptrend. But what you've got to do is you've got to ring the peaks and the troughs, okay? Then connect them up. What have we got here? Nothing. Let me tell you what an uptrend is. An uptrend is where you've got higher highs and higher lows. So write that down. Uptrend is where you've got higher highs and you must have higher lows, you must have higher highs. A downtrend is where you've got lower highs and lower lows. And when you've got a mixed bag, like you have here, you've got nothing, you've just got a range.
What period do you need to get back to determine that?
It doesn't really matter. It doesn't, who said that? Yeah, it doesn't matter. Whatever the period of time that you're looking at. So for example, if you're trading daily charts, as long as you've got 3 touches in a line, you've got a trend. That's the key. Because people say, well, is it 6 months? Is it 9 months? Well, the markets are changing all the time. I mean, time is everything. But it's the only way we know we've got a trend is based on touches. Does that make sense? And when we've got touches, we know we've got trend. We can then do something useful with it. Unless we have touches, we don't. That's the key. Okay, sure. So look, let's do this. Draw the trend line. Let's get used to drawing the trend line in. So the strategy of drawing a trend line is, what do we look for first? We look for the touches. Where is it touching? And then we draw a line through it. So do this in your notes now. For those of you who have traded before, don't panic. I need to make sure that the whole room is grounded the same way. Okay? So for some of you, this is quite elementary. And I only apologize for that. But I have to make sure everyone's grounded correctly. Is that okay with you all? So for some of you, this is a little bit revision. Okay? Just hang in there with me. I'll get you. Don't worry. But for some other people, this is new. Okay? So, you know, we just have to kind of broad stroke it. But it's important that I make sure everyone's clear on everything. Which means I've got to cover all these bases off, which means, you know, even some people who've been trading for a long time still screw up drawing a trend because they just wang a line on where they think it is. No, we've got to look at where those touches are and then draw a line through that. So for some of you it's elementary, just use it as a revision, okay? For other people it's new. Okay, everyone good? Yes or no? Yes, are we there? Is that pretty obvious? Yes or no, people? Did you have your line there? Okay, my question is, why not? So your line should be along here. Why should it be along here? And then we break here. This is where we break. Oh, okay, here we go. We just, look, this is important, okay? This is not paint by numbers, okay? This is very important. This is not paint by numbers. So please don't expect it to be an exact picture, okay? And you're going to learn this with trading. There's no such thing as a perfect picture on a chart. Does that make sense? So when we look at things like cyclicity, which we're going to get into, price cyclicity, people automatically think that a price cycle should actually look like a nice little bell curve. Does that make sense? It should go up nice and pretty and down nice and pretty, okay? Because we're so used to seeing that. What you've got to look at in price is where is the trend of price and where are the low points? And all you've got to say is there's a low point here, there's a low point here, there's a low point here, and then it breaks through here. I've got my points, I'm in. Does that make sense? Now you can also see it's come down, it's not quite touched here, but you can see it's consistent with this trend. Can you guys see that? And then here it's broken through. With all trading, there's going to be a little bit of interpolation of data, and there's going to be a little bit of futzing. Okay, it's never going to be a perfect, like it's going to, on a perfect gradient. But you've got to look at where the market's really coming down and touching. Does that make sense? In other words, you can't just draw a line across wherever you fancy. You've got to say, well, where are the majority of these touches coming down? We have here, we have here, we have here, and then it kind of bounces up, and then we fall through. Does that follow? So really between here and here, we can say we've got something going, 1, 2, 3, and then as it starts to then move, this could be a long period here, but then when this was to then break down through, this might be then an exit. There's no trading strategy here anyway. It's just the definition of a trend.
So the same rules apply here no matter what chart we're looking at?
Yeah, it doesn't matter what chart. Yeah, any time frame, 5 minute, 15, 60, it really doesn't matter. Do the same here. Draw the trend line on this one. Okay, what's going on with this? Nothing. Does that make sense? If you stick to what we said, we get the answer. If you try and guess, look, what your brain is always trying to do, your brain is always trying to see things that aren't there. Does that make sense? So we have some rules which are, look, we have to have, what's this? So for this to be a downtrend, for example, these lower lows need to be lower each time, don't they? And then the high lows need to also be dropping. Is that true? But they don't do that. They go up, they go down, they go up, they go down, they go up, they go down, and they go up. Does that make sense? So in other words, there's no consistent pattern. They're a bit lower, then they're a bit higher. And if you just draw the line through them, we can see that all we're really looking at here is just a reversal of movement. It's just a consolidation, not even a consolidation, it's just a sideways movement. Does this make sense? But it's so easy for the brain to go, that looks like it's going down more than it's doing anything else. That's not true. Yeah, scalpers would do that. They'll see it moving up and moving down, moving up and moving down. And then, of course, what they'll end up doing is they'll just jump in here and say, okay, well, I've seen it. Every time it moves up to here, it kind of moves down, and it moves up to here, moves down. Okay, so it's here, then it goes down, so I'll sell it here because I think it's going to go down to here, and then it just does this and takes them out. Because it's just randomness. Does that make sense? And people do this all the time because they think it's easy money. Because Forex will move quickly. You'll see 20 pips of movement in one direction, and then you see 20 movements in the opposite direction. And all you need to do is guess which direction you think it's going to go and be right once, and then you'll put money behind it the second time. Does that make sense? And it's completely devoid of any strategy, and the chance of making money from that long term is ridiculous. Okay, this time what I need you to do is I want you to draw the line, draw the trend line, and just show where it ends. So what you're looking at, all we're doing in this process right now is getting your brain used to looking at where is the trend, what's likely to continue, and then getting your brain to see, well, okay, and where do things end? Does that make sense? That's it. That's all it is. Really, really simple, but really, really important. Where does this start? Where are we? What's going on? And then where does this over with? And so in this example, we see this, don't we? We see the line across the bottom here. And what do we see here? This is the point where it's over. Is this true? Yeah. So we understand that, between here and here and here and here and here, this is where we've got the trend movement. And then here is where it's all over. Why is this important to establish? Well, it's important for us to establish at what points we can then take strategies and at what points we cannot. We've got to be clear in our mind which direction the market's in. And if we can't be clear about which direction the market's in, we cannot place any trades on that currency pair. It's as simple as that. Does that make sense? So we have to be really clear. Where is the relative polarity right now? Are we more buyers? Are we more sellers? And then from that, we then take a trading position based on that. Okay, so no, here's why. What makes a trend line valid? Yes, that's true. But there are 3 points on the line you were just talking about, correct? So here's what makes a trend line valid. A trend line's got to be valid. It's got to start from where it ended. Do you see what I'm saying? So from here, this is where it ended. This is where this market was moving down, and this was the first point, the low point. So we've got to go from the low point and then draw the trend line from that point there. Does that make sense? That's right. Where it goes from one polarity to the next. Is that true? Because you can have a trend which does, say for example, this and this and this. You can also have in between it little bits that do this and this. Is this true? Yeah, and over a shorter period of time, you can have another little trend within a trend. Is that true too? Yeah, so what we're looking at here, and regardless of what this is a daily chart of your currency, Aussie dollar. This is your low point, which is here. And this is of which we're building the trend. So I go from here, and I go from here and here, and I have a line. Yeah? Or you want to go up to here? Is that what you're saying? Yeah? Yeah. Okay, there's two things. Okay, great. Yeah, just tell him to set up. There's two things to this. Number one is we've just got to establish the trend. Okay, and the trend we start from, the lowest point, and then we draw the lines. Now you've got a line here. And you've got to remember that at this point here, let's take this line here. Okay? And my question then becomes, well, should I still be long this market? Should I still be buying this market here?
No, because it's a second touch.
What should I do?
Why would you even look at this one? I mean, this past history.
Don't worry about it. What should I do here? Okay, let me answer this for you. Look, the fact of the matter is, if this is my original trend, it doesn't really matter. If this is my original trend line here, okay, if I'm saying this low point here, to this point here, to this point here, I'm only on point 2 here of this. Is that true? Okay, so if this is my line of trend that I've drawn here, let's say I take this as my line of trend, I'm going to do it in red. If I'm taking that as my line of trend, when do I have the trend established? Let's say 1, let's say 2, let's say 3. Okay? So am I good long north of this? Yeah. If I have this as my line of trend, am I good long north of this? Yes, but at what point? How many do I need? Okay, so I have 1, I have 2, I have 3. Is this true? And what happens here? Trend over. True or false? Trend over here on this one? 1, 2, 3. So if you look at here, trend over. Correct? So if I'm using this as my line of trend, 1, 2, would I exit the trade here? Possibly. Possibly. If I'm using this as my line of trend, I need to establish I've got 3 touches in place first. Is this true? So we know that we know so far how we can draw a trend line in, but what we haven't quite learnt yet is where does the price need to be in relation to not just the trend but other factors? Have we discussed the other factors yet? Yeah, so we kind of did. We started talking about that 50-period moving average, didn't we? And we started talking about the 200-period moving average. Is that true? Yeah, and we aren't really looking at those yet. We're going to build that layer on. Right now we're just looking at the trend layer, true? And we've decided that, okay, depending on what we've drawn our line as, whether it's on these peaks, whether it's on these troughs here or these troughs here, will tell us where we can get in and out of this position based on just the trend alone, true or false? What are we missing in this picture? We're missing moving average lines. We need to know where those moving average lines, because they will tell us if you can have a little trend inside a bigger trend. But those little moving average lines are going to tell us whether if the price is above those moving average lines, we're going to be looking for long positions. That doesn't mean we're just going to buy, but it means we're going to be looking for long positions above those moving average lines. If the price is below the moving average lines, we're going to be looking for shorter positions. Does that make sense? So where we are right now is we're just layer 1. And layer 1 is, let's just start establishing the trend. And more importantly, look at where the trend is broken. Make sense so far? Let's see the next one. When we're in a downtrend, what do we want to see? Lower lows and lower highs. When we're in an uptrend, we want to see higher highs and we want to see higher lows. So go down here. Draw the trend line here. Okay, first question. Are we getting lower lows? Yes or no? Are we getting lower highs? Do we have a trend? Do you follow the peaks across here? Yes or no? Next one. Are we finding lower lows? Yes or no? Are we finding the highs lower? Can we put a line across? Yes or no? Say again? I see what you mean. Do we have, is this point here close enough? Yes or no? Actually, it doesn't come up. All you've got is you've got one touch here, moves away, it doesn't come back, touches, and then drops. Okay? It doesn't mean anything. It just means it's not cyclical. It's not producing perfect symmetry. That's all it means. Yeah. What about here? What's happening? Nothing. True or false? So look, the key is, with all of your positions that you're going to place, we mustn't take positions if we don't have a clear trend established. You are going to trade strategies. Okay, and strategies are going to tell you exactly where to get in, where to get out, when to take profits, when to move your stop losses. If we don't have a clear trend, does this kind of ruin a strategy in the first place? Yeah. So we need to be clear on where the trend is first of all. Let's look at this one. Where's the trend, and where is the trend breaking here? Okay, so look. Here's where we've got our touches. Here's where we've got our break at the end. Yeah. So what we're looking for here is we've noticed bounce, bounce, bounce. This is where we're getting the bouncing across.
Yes, but the moving average is below it.
That's right. The moving average is below the... This, you mean the red line here? Yeah, that's right. The moving average is below the price, as it should be. No. No. Where should the moving average be? Above or below? Below. Yeah, you want the price to be above the moving average. Good point. Let's get into the moving average. We've only seen, so look, we have one layer. Let's just be really clear on where we are. We need to establish the trend direction first. We get that by 3 touches in a direction. Everyone clear on that part? we are still like 65,000 feet. We need to come in closer to see where we are. Now we need to look at, well, where is the price in relation to the moving averages? Now, what is a moving average? Well, it's the sum of a load of prices. So let's say we take the price that took place on 50 days, and we then divide it by 50, and that's going to plot us a line of what's happened to that. It's going to smooth us out a line of what's happened to that price over 50 days, which is a quarter of a trading year. True or false? Yeah, and then we're going to look at another line, which is the whole trading year, which is the 200, which is 200 trading days over the whole year, and we're going to plot that out. We are going to use not just regular moving averages or simple moving averages, we're going to use what we call exponential moving averages. And the reason we're going to use exponential moving averages, all they're going to do is they're going to weight the data to more recent pricing data. Does that make sense? And the reason we're going to do that is because we are mostly trading. And therefore, we care more about recent pricing data than we do what happened 50 or 200 days ago. So we're going to always use the exponential moving averages. These are the colors. With the 50, we always have it red. With the 200, we always have it green. With the 20, we always have it blue. And with the 10, we always have it black. We will buy positions when we're moving above the 50 and the 200. We will sell positions when a stock or a currency is below the 50 and the 200. These are standards. These are absolute standards. So, for example, take the euro here. Notice that the 50, the red line, is below the 200. What does that tell us? Well, it tells us that more recent pricing data has been falling. Does that make sense? That means historically it was a little bit higher because the 200 is above the 50 and the price is below both of those lines. We would be looking, we'd be looking for short setups. So you can see the 50 is below the 200 and the price is below the 50. That's the only time we take shorts on. So we know that the price is the right side of the moving average lines, and this is short territory. We then obviously look to see what the trend is, where the trend is bouncing off, and we then look to take positions on. The strategist will take care of that part. In this example, we can see that we're looking long, okay? We look at the price. The price is above the 50. The 50 is above the 200, okay? So we don't look to take positions when the price is below the 50 or the price is below the 200. Why don't we do that? Because the probability of success is significantly reduced. And our job is to increase the probability of success and reduce the risk. So the key here is if price is above both the 50 and the 200, nice smooth established uptrend, we would be on alert for potential long setups. Is that the only time we go long? Yes, it is. It's the only time we go long. And the question is, when would we, generically go long? Well, we would look at how price moves here. Price moves like this, and it 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 moves like this. And you've got to understand that the price is like it's breathing. It's like you've got to think of it in terms of lungs. And most people try and trade the markets at the point, it's like trying to breathe in after you've just completely breathed in. What must follow after you've just breathed in? You've got to breathe out. And what most people are trying to do is enter positions getting more breath in when the lungs are already fully expanded. And they have to breathe back out. Does that make sense? That's because people wait to see these little movements upwards. They're buying here, and then they can't believe it falls. And then they watch it move again, and then they buy it here, and they can't believe it falls. And then they watch it run a bit more, and they buy it, and they can't believe it falls. And then again, they watch it run a bit more, and they buy it here, and they can't believe it falls. And then they've had enough. Then they go play golf. Yeah, then they've had enough. Does that make sense? People trade the extension, not the pullback. And so we've got to look always when we're trading long positions. First, the rule number one is we've got to be, all we're looking at here is when we would be alert for long setups. To be alert for long setups, we need trend and we need the price above the 50 and the 200. Is this true? Yes or no? Good. And when we're short, we want to make sure that the price is what? An established trend below the 50 and the 200. These are de factos. We can't screw with this. This has to be like our mainstay, okay? So we just look at any chart. Firstly, you go on any trading floor in any part of the world, any professional trading floor, you speak to any trader, you say, look, what's going on? And the first thing they do is they draw a line on the chart. Why do they do that? Well, because they want to know where the trend is. They have to look to see where that rhythm is. And then they look at the price in relationship to the 50 and the 200. Now they know roughly what's going on. That's long before they've even considered placing a trade. Does that make sense? That's like starting to get that map down. Because if you're foreign exchange trading, on go the pivot lines, we see what's going on, and then we move from there. Does that make sense? Okay, so that's key. That's our environment. We've got to operate within that. So we just have simple rules. We don't go short when the price is above the 50 and the 200. We don't go long when the price is below the 50 and the 200. And we've got to stick to those rules. So, okay, let's say we're looking at this chart here. And we're here now. What do we do here? Do we go long or do we go short? How many people say short? How many people say long? How many people just don't know? Okay, look, the price is what? It's above the 50 and the 200. We would be looking for longs. What about now? Look, this doesn't matter. This matters. This is now. So what would we be looking for? Longs or shorts? Shorts. We have trend down. We're below the 50 and the 200. Make sense? So you now know, when you're looking at the daily chart, never make this mistake. If it's below the 50 and the 200, we're looking for shorts. If we're above the 50 and the 200, we are looking for longs. Good. Okay. Now let's talk about principles of support and resistance. Principles of support and resistance. I'm giving you trading principles that you can use across Forex and futures markets, which are important. Trading in a nutshell is really about having your eye on a few time frames. So when you trade in the currency markets, now, unlike anything else, you're always looking at what that daily chart is doing. Because the daily chart, when you're trading the currency market, let's say, for example, you're going to trade for an hour at some point in the day and you're going to take like a pivot trade on. Well, the first thing you do in the currency markets is you always look at the daily chart and say, okay, are we going up or down? So the exercise we just did, you do across daily charts of the currencies you're trading. Does that make sense? And until you're really clear, are we going up or down with the euro, or are we going up or down with sterling? We just don't do anything else. We never dive in. That's the point. We never just dive in and go, I see a movement. We don't do that. We must just be really clear on the polarity. The polarity is either up, or it's down, or it's down, or it's up. Does that make sense? That's kind of like stage one. That's stage one. Let me talk to you about stage two. Cyclicity. We're going to cover cyclicity tomorrow, but I want to kind of get your feet a little bit wet on it. If this, let's say, for example, this is a downtrend. And let's say price is kind of doing this, look. Now, watch this. Uptrend or downtrend? So what kind of thing would we be looking to do? Okay, good. So we'd be looking to go short, but now I want to do this. Draw this in your notes. Good. So this is what we call price cyclicity. Notice how price moves up, moves back down, moves up, moves back down, moves up, moves back down. And let's put some numbers on there. Now, we call this phase 1, 2. Okay, this is called phase 1, 2. Whenever we are trading, we want to make sure that we are never trading in phase 2. Okay, so we never want to trade in phase 2. Okay? We never want to trade in phase 2. See, I just said to you, look, if the 50 period moving average is here and the 200 period moving average is here, then we want to be going short. Yes or no? Yes. But then if we did go short in phase 2, we'd still lose money. Wouldn't we? So the key is we only want to be going short half the time. And with the trend. We never trade phase 2 ever. We would never buy phase 2. We'd never do that. All we ever do is we trade this part, and this part. Does that make sense? Because the probability of success trading this part, and this part is strong. Trading in 2 would be what? Trading against the... Let me trade against a stupid thing to do. So if I then look at this as a long position, let me do this for long, just so you're really clear on what this looks like. You guys get the idea, right, with the different colours? This would be phase. So we only want to trade, so that would be what it look like for long. So we only want to trade in the phase 1 of either side of the trend, whether it's long or short. So, and again, where we're looking for, I'm drawing the little blocks. That's around these turning points. Just as a general principle, just as a general principle. I'm going to teach you proper strategies anyway, but I want to give you general trading principle, okay? Just so you're aware, this increases your awareness. Yeah, you can do any time frame. Yeah, no, if the daily's down, whatever time frame you're trading below the daily, you're always going short. You're never going long, ever. You're always going short. Okay? Everybody clear, yes or no? Okay, good. Crikey. Okay, good. So, what I'm saying here is we use more than one time frame to tell us what's going on. Generally what we use is we use that daily to set the trend, and then we're generally placing trades using intraday strategy, whether they be pivots or sniper type trades, using that daily to dictate to us in what direction we should be running. Okay, so let's have a look at this. How do we get into trades? What are the principles of getting into trades? Trade entry. And these are just generic but critical principles that I want you to be aware of. So you can apply these principles to any type of trading, but they're critical in Forex trading. But it's important that you have this level of trading mastery. Does that make sense? I want you to be aware of these things because they're crucial. Now, I've said to you before, when support becomes resistance, resistance becomes support. Yeah. So, for example, when a line, let's say, for example, you've got price which is doing this. And we're going to say this is a line of, yeah, so that's a line, isn't it? This is a line of resistance. Now, what happens when price mounts this line of resistance? What does this line now become? Yeah, the same line becomes a line of support, and that's how it changes nature. If the price then breaks back down through here, what is this now called? Resistance again. So it's always relative. It's always related to where the price is in relation to the line. If the price is below it, it's resistance. If the price is above it, it's support. The more factors that converge to a single boundary, the greater the probability it will support or resist price change. So when I say the more factors, what could those factors be? Well, it could be a line of resistance, a price point. It could be a moving average running through that line, or it could be a pivot line running through that line. Whatever is on that chart, which is likely to provide support or resistance, will ultimately, the greater number of factors and elements that go through that point will either create support or resistance, which is a bounce point, which will prevent price from moving onwards. Okay, how do we get into trades generally? Well, the trigger point, when we enter trades, it's about understanding where the lines of support and resistance are. It's about recognizing if there's a particular pattern. It's about evaluating the reward and the risk. So is it worth placing the trade based on how much risk is on the table compared to the reward? And then does this really make sense? Is the 5-minute chart and the hourly chart, is it really matching what that daily chart is telling us? Or am I doing something stupid? Am I just jumping into something I've seen on an intraday chart, and yet I'm ignoring the bigger picture? These are all the elements we've got to weigh up before we try time the entry. Now, okay, undersized bars. Let's just cover this. We're going to cover this on trading cycles, but let's cover it here. We enter trades that are small, undersized bars. We look to enter trades when they're small, not big. Now, the bars on the chart vary in size based on the price action that's within the bar. So say, for example, this is a little bar. And we know that the price hasn't moved much. And then this is another little bar. And we know that the price hasn't moved much. And then this is another little bar, and it's moved a little bit more. But then suddenly it really gets going. And then it gets going a lot more. Now, what's happening here? It's just, the market's just getting confidence in one direction. That's all that's happening. Okay, so there's just more and more buyers entering the market, which is stretching these bars, because these bars are all uniform in one thing: time. It just means that you've got more buyers in this period of time than you had in this period of time, hence why this bar is bigger than the previous bar. Problem is when you look at this on a cycle, it tends to look like this. That's how a cycle looks, for example. And there are different stages in that cycle. This would be, say, stage 1, this would be 2, this would be 3, this would be 4, and then this would be 5. And the point is, as I said before, it's not like painting by numbers. It's never really symmetrical. So you never really know where you are in the cycle based on the symmetry, the picture. You only really know where you are in the cycle based on what the bars are doing. So if the bars are small, you know you're either at stage 1, stage 3, or at stage 5. And if the bars are big, you know you're at stage 2 or you're at stage 4. Does that make sense? Okay. The entry points for entering a position would be at stage 1, exiting at stage 2, entering at the beginning of stage 4, and exiting near stage 5. Where we don't enter positions is in stage 2 and stage 4. In there. We don't want to enter positions on that. Why is that? Because the likelihood of success is massively limited. Why? Because the market's already underway. It's already in session. If people say, I want to get into this because it's moving, we have to correct them and say, no, it's already moved, and then you've got to move on. Does that make sense? So people go, oh God, it's moving. And what people are, the two psychological reasons people enter trades, generally untrained, unstrategized, is social proof and excitement. If you see an excited market which is moved, an excited market, the definition of one is where the price range movement, the volatility, is greater in that period of time than it was previously. Hence the elongation of the bar. More people are buying it in that 5-minute period than were in the previous 5-minute period. Does that make sense? So there's a lot of activity there, and there's obviously some social proof. That gets more and more people involved. Professional traders cannot buy on those bars. They cannot buy on those bars. What they're doing is they're buying previously. What are professional traders doing in here? Yeah, big professional traders, the only thing they can do is sell here. That's the only thing they want to do. They sell into that rising market. It's the only way they can offload a position without that position dumping on them. Does that make sense? So what you've got to look at is the professional money is selling on these movements. They're offloading on these movements. So they're getting the best possible price for the currency they've already purchased. Does that make sense? And then the junior money, the junior money is buying these movements because they're seeing prices going up. So what that means is that we enter trades when the bars are small, generally. We look to enter positions when the bars on the charts themselves are small, which means that the move is not already underway. Does that answer your question? Yeah. So we want to make sure that the bars are small, and then we want to make sure that there's a trigger point which is attained based on analysing those 4 things, which is time and making sure the reward risk. These are just the general principles. We'll cover these. All of your strategies are going to be consistent with these. But I want you to know why that they're there. The price penetration point is the point where the bar kind of breaks through a key level and expands sharply towards the next barrier. And that's really the basis, if you will, of most trading strategies. This price penetration point, and it tells us this is how we define how much reward is in the trade, how much risk is in the trade, and then it tells us whether we should do the position or not. If you take a look at the following example here, here we have this pivot line. I want this line in blue here. Now let's say, for example, let's say we would sell through this pivot line. The question becomes, you're going to see this tomorrow when we talk pivots, the question really becomes, at what point do we sell? Where is that price penetration point? Does that make sense? Because clearly the bar, it could go through here and it could bounce back up. So what do we as traders use as a signal to tell us, no, we should actually go short now, and this is the point of doing it? What is that price penetration point? And if you look here, just to give you an example on an example of price penetration, notice this little bar here went through this line of pivot. Do you see that? Notice how this bar here closes through, and it closes down. Do you guys catch it? Notice then how this, so what we then notice is we have a little floor here. Do you guys catch it? So in other words, it went through, went back again, went through, went back again. We would not, as a general principle, be short at this point. Now, junior traders would, as soon as they see the price go through that line, they press sell. We can't do that. We've got to wait for this next bar here to take the low out that's been established. Does that make sense? And that is what we would call a price penetration point. When we talk price penetration, we look at bars which come down. Let's say this was where we wanted to get in, on this blue line. A novice would go short here. Does that make sense? We don't go short here. We must have a confirmation of the entry. So we wait for the next bar to open and then take the low of this bar out. And as soon as we see this happen, this gives us a price penetration point. Does that make sense? You're going to see this when we cover pivots properly tomorrow. But the point I want to bring up is where we decide to enter the trade, the area of penetration, the price penetration point, that helps us decide how much risk we're going to take on the trade, because the risk is defined by where we get in and where we get out if things go wrong. Is that true? And then we measure that against our target to tell us, okay, is the reward risk at least 1-to-1? And we're going to cover risk management tomorrow, don't worry. But we're going to look at, am I risking at least what I'm looking to get back on this position? And if I've at least got that in currency trading, I'm going to go ahead and place a trade. I want at least 1-to-1. But do you see that this could be quite a dynamic situation? And until this happens here, until this little bar breaks down, takes this little dotted line out, which I now know is my entry, I can then say, okay, if I enter here, as soon as this bar closes, I know what the low is. I now know what I need to break through to get through this. Does that make sense? As soon as that bar closes, I know that I've got to take that bar out. As soon as that's taken out, I'm in this trade. Well, if I decide that I'm going to stop myself out up here, so in other words, I'm looking to go short. And I know if I get through here, my entry price is here, that's E for entry. I know S is my stop loss, and I want to go short. I want this thing to crash all the way down to here, so I can take my profit down here. I now know my risk, don't I, which is between where I come out if it goes wrong and where I got in when I placed the trade. And the distance between these 2 points is called my risk. So that price penetration point is the point which tells me where should I get into the position. And when I know where I should get into the position, I then know how much risk I should place on the position. Does that make sense? So these principles are principles which are going to cover all of the strategies you're going to learn. I want to make sure that you're aware of the principles before we just jump straight into the strategy, so you guys have got a good understanding as to how and why they're applied. Does that make sense? Yes. Okay, good. When we enter the position, the question we immediately ask ourselves is this moving as I intended? Is this moving as I intended? So before we place any of the trades, we're going to be really clear on what we expect to have happen. And then after that's happened, is it doing consistent with what I thought it would? And the way we'll know how to do that is we're going to teach you price range cyclicity, and you're going to say, okay, it starts here. I expect over this period of time it to be here. Is it here? And if it isn't, we're going to look at the actions that we take. Now, with trade entry, it's always a case of, as we just said about the small entry bars, it's always about the calm before the storm. We aren't looking to get into positions which are already raging in a movement, because they're already over. We want to get into positions where there's a calm before the storm. And as you can see here, it's a classic example. It's quiet. And for you as a trader, this is what you're looking for to enter a position. You do not want to see it raging in a direction. This is an example of where the market is already up. So we have trend direction in this direction. I can see the daily chart behind it. And all we're looking at here is this market now breaking up. And this nice, quiet, calm movement is what we're looking for in terms of entry. Okay? We aren't looking, so this is counter what other people, when markets are crashing around, they can't wait to get in. We've got to do the opposite of that. Does that make sense? And that means that our risk can be kept nice and small, limited, and we can get into a trade elegantly and then out of a trade elegantly. Okay, let's just look at some of the risk principles. Rule number 1, we never enter a trade without first knowing our bailout plans. And so what's going to happen tomorrow is you're going to learn setups. You're not going to have to figure this out on your own. But you know the principles, so you know why it works. The setups have risk based on the distance between the entry and the stop loss. And therefore, we never just get into a trade and then think later about where we're going to get out if it goes wrong. All of the setups have positions of where we get in, where we get out, and it's completely entirely based on strategy. Okay? So there is no discretion that we use at this point. We have an entry price, we have a stop loss, and we just run it template, cookie cutter every time. Does that make sense? That's exactly how it runs. 2, we find low risk entry positions, which means that these are close to technical levels or they're following decent retracements. We reduce the risk by entering positions with small buys. We don't get into crazy kind of volatile situations which have already moved. We look for less volatile markets for our setup, so we make sure that we're in a position where we are first person in, first person out. That's how I want you to think of this. You're first person in, first person out. And when it comes to coming out, what are the principles of exit? Well, let's say we are already buying something. When should we be taking a profit? The best time to take a profit is when we see the oversized bars that are approaching strong resistance. This is when we take profits. This is the opposite of what the amateur novice does. The amateur novice, when they see the oversized bars, what are they doing? They're getting in, they're getting excited because they go, oh, people are buying. No, professionals are unloading and novices are buying. Always. So if we're in a position early, and the position then starts to move and we have oversized bars, people are always asking the question, when should I get out? When should I get out? Is it an oversized bar? Yes or no? If the answer to that question is yes, and it's approaching some strong resistance, we should be exiting the position. Does that make sense? Because what will otherwise happen is it will stretch up, touch the resistance and pull right back. And that pull right back will be sharp because the market will then suddenly be aware of all the offloading that's taken place and it will really pull back quickly. So we want to be in positions early. We want to be in where the bars are small, where our risk is limited. And when it starts to stretch upwards, approaching resistance, we're happy to come out. Remember, nobody ever got fired for taking a profit. Is that true?
So that the next bar will be shorter than this one?
The next bar would be shorter than this one? I mean, after an oversized? Yeah, generally. Yeah, when you have the full extent and you have the high test bar, which we're going to cover in a minute, we then expect bars to either shrink or they can move back very quickly.
So what if the next bar is smaller than this one?
There's nothing wrong with taking a profit. So for example, if you've got strong resistance and you have an oversized bar and then the next one is big, and let's say you've got resistance here, and you entered the position, let's say you bought in here. If you saw this big oversized bar here and you're approaching resistance, which is here, exit. Why? Because the likelihood, when you have an oversized bar here like this, it means that there's been a lot of buying activity here approaching resistance. The likelihood of this then turning around and sharply reversing is very, very high. Why? Because professional money cannot sell into a downtrend. Well, it can, but why would they? If you sell into a downtrend, the price is going to move down so quickly, you're going to get a terrible price for your position. So professional money sells into uptrends. Does that make sense? So when finally these oversized bars come out, you're going to find that if it's approaching resistance, when it sharply comes off, it will move quickly. So what this allows you to do is exit a trade, take the capital, and then move on to the next position. And it's a principle that must be adhered to. Juniors, when they first start trading and they see oversized bars, what do? They get really excited and they start buying more because they think this is never going to end. This is incredible. Finally, I've got onto that trade, the one that's going to make me my fortune. And they just start going crazy. And then suddenly what they've done is they've increased their trade position size to the point where it's way outside of their risk controls, and then suddenly it starts sharp reversing, and they can't unwind it fast enough. Does that make sense? So the key is when we start approaching strong resistance, as a principle, we look to exit and take profits. What you're going to learn throughout your trading strategies that we're going to teach you tomorrow is we're going to teach you how to trail stops. How to trail stops. At what point should we move stop losses? At what point should we leave them where they are? And you're going to notice that the trading strategies that you learn tomorrow have defined rules about where we move the stop losses to. The stop losses obviously is the order to close our existing trade. Is that true? Yeah, and they're completely strategy based. So for example, if I enter a position, say it looks like this, and it moves and it runs and it moves and it runs and it moves and it runs, well, I'm going to start off with my stop loss here, and then after my position runs, I'm going to be looking to trail my stop loss up based on the congestion patterns that then form. Is that true? And what you're going to notice is that in trading, people make one of two mistakes. They either move their stop loss too quickly, and if they move their stop loss too quickly, do they risk getting stopped out? Yeah. Or they leave it where it is for too long. So ultimately, they're just leaving all the earned profit or the unrealized profit on the table, which then gets pulled back. So understanding when to take profit and then when to leave the stop loss alone is critical. It's not just about trade entry, it then becomes critical. It should not be left to trader discretion. It must be strategy-led. This is a part which is crucial and must be strategy-led. When you learn to trade the income generator, which you're going to learn tomorrow, you're going to see very quickly that you're going to understand most of the power of this strategy is really twofold. Number one, it's a 300 to 500 pip puller. But number two, and most importantly, when it fails, it doesn't take a full percent. The stop has already been moved by the end of the third day, and your 1% loss has suddenly shrunk down to, say, 0.2 or 0.3%, and that's critical. Does that make sense? And it's all completely strategy-based and strategy-led. Now, where do we put stop losses? Well, let me say this. Stops, we decide up front. Where is the target we're going for? And we decide where our stop losses should be, and we should make a decision that stop losses left in no man's land are naked. Okay, stop losses left in no man's land are naked. So we've got to put stop losses in a place which are protected. What does that mean, protected? Well, imagine this diagram here. Let me just jump to this diagram for a second for you. The reason the stop loss here is placed under areas of support is because it's likely that if price came back and retested one of these areas, it would settle and then move back off again. Does that make sense? So where stop losses are always placed are under things which protect it. We never leave stop losses in these zones. We never enter trades in these zones. We never leave any orders in these zones. So what you should really learn from this is where the price is moving, there really shouldn't be any orders. There shouldn't be stop losses, and there shouldn't be trade entries. Does that make sense? Where it's fast moving. And that's always where amateurs are entering trades and exiting trades. You know, we want to be looking to enter the trades before that move's happened, using orders, and placing stop losses under things which protect price. And the things that protect price are things like support and resistance, highs and lows of preceding bars, pivot areas. And we use the plan, which is the trading strategy you're going to learn tomorrow, until our experience tells us to do something different. So we always use the plan, and that's what we're going to do. We're just going to use plans that you're going to learn tomorrow, and then we're going to trail stops based on these things. Support and resistance levels, under moving average lines. You've got to think, what is it on the chart that can provide some protection to me? And these are the things that will provide protection to your stop loss. A trend line, because a price is likely to bounce a lot along a trend line. Is that true? A price is likely to bounce on a pivot point. Is that true? Price is likely to bounce across moving average lines. Is that also true? So these are the things that we're going to put our stop losses underneath. The question you've got to ask yourself is, well, which one would I use? Which one do I use? And the answer is this. You don't guess this. This is not guessed. We use a strategy. Otherwise, you're in that no man's land of sitting in front of your computer screen trying to be a trader when you have little experience in it and just second guessing all the time. Does that make sense? It must be 100% strategy led. And then after a period of time, you start to get some an awareness of how that currency pair moves. And when you understand how the currency pair moves, you can update your strategy based on the character of that currency pair. And then you get a little bit better. But the key is up front, we've got to put a strategy in place which tells us exactly what we do, when we do it, and keep to that and stick to that. So, okay, we're gonna jump to patterns. Let me just quickly recap on that. Key technical levels. Support and resistance levels. Previous day's highs and lows. Under moving average lines. Above moving average lines. These are places where stop losses should go. Under pivot points and under trend lines. These are all the positions places where we place stop losses. Yeah. Yep. Yeah. How do you know we do? Good question. So let's say you look at a 1 hour chart and then you look at a daily chart. Which moving average lines would you use? The answer to the question is, whatever your central time frame of reference is the time frame of reference you should use. So for example, let's say you're trading a 60-minute chart. Well, on that 60-minute chart, you should be using the support and resistance levels on that 60-minute chart. You should be using the moving average lines on that 60-minute chart, because they're the ones which are going to dictate the price range cyclicity of that trade, aren't they? Do you see what I mean? And obviously, as you work down the time, let's say you went from a 60 to, say, a 30 to, say, a 15 and then a 5, and you'd have lines all over the place, wouldn't you? So the central time frame of reference is the one you're going to be trading. And for you guys, when it's intraday, you're going to be looking at the 15-minute, write this down, the 15-minute, and then ultimately the 5-minute. A 15-minute, and then the 5-minute. You guys good? Okay, good. So, okay, let's get into some price patterns so we can understand how price patterns work. And let's really start kind of digging into, this at a sort of a deeper level a little bit more now. We're starting to understand some of the principles. What I want to do now is just give you a better understanding, and then we'll start to integrate. Okay, so where we are right now is we're understanding some of the environment. Is that true? Yes or no? Yeah. Don't worry, I feel your pain. It's like nanu. It's in the middle of my nightmares. So look, I know where you are. You feel like I'm a freaking robot. I know where you are. Oh Jesus. Oh, good we can laugh, isn't it? But listen, we've started to talk about the environment. We've talked about not trading around news. We've talked about what news is important. We've talked about the impact of news on the currencies themselves. Does that make sense, people? Yes or no? Yeah. So what we've also done is we've then started to look at the trends, and we've started to understand a little bit about when we'd pull the trigger, where we'd start moving stop losses to, but it's kind of loose still. Does that make sense? It's still kind of loose. There's nothing concrete yet. Good, there shouldn't be. But what we started to do is we started to understand the environment a bit more. And all we're going to do over the next day and a bit is we're just going to get more. It's like, imagine, you've got like a camera lens and it's zoomed out. All we're going to do is get sharper and sharper and sharper and sharper. That's what's going to happen. Okay? So, let's talk about what happens before each trading session. What would happen? Well, these are the questions. Remember, the best answers in life come from asking the right kind of questions. And so the questions that we are going to ask before we trade every day are the following. We're going to ask ourselves the question, is the currency bouncing off that little pivot line in the middle? Is it bouncing off that? Or is it at the support level? Or is it the resistance level? What is it doing? Does that make sense? If we're looking at the euro and it's in a downtrend, is the currency breaking through that pivot line, or is it above it still? What is really happening? When it's above the pivot line, traders kind of look for long positions, and when it's below the pivot line, they look for short positions. But they always make sure they look at the daily trend direction first. So we've got to make sure we're kind of aware of that. And then we look at that daily chart and we say to ourselves, what's really happening? Where is it bouncing? So and we're going to do this when we start looking at some of the charts. But I just want to get you kind of thinking of the kind of questions that we've got to go through as part of this ritual that we're going to do every day. And I want to give you the same ritual I use so you think the same way and do the same thing and get the same results. We check the daily charts. We check where it's bouncing around, what it's doing. Then we check the news. And we ask ourselves the question, is anything happening here we should be aware of? And we look at those hourly charts, those 60-minute charts, and we say, is there any major support and resistance levels I should be aware of? What's really happening here? And then we look at those pivot points and we check the intraday volatility and see where things are moving. This just gives us a handle on what we're doing and where we are. Does this make sense to people, yes or no? Yeah. So we just never go in blind. We never just go in and just jump onto something. This always creates problems. And often when people keep accurate records of what they do, the days where they don't do this kind of ritual up front normally means other days they tend to be losing days. Let's have a look at some principles which take you beyond just what we've learnt already. Let's talk about a low test bar. Now, a low test bar is whenever we have a bar on a chart. During the bar, first of all, we said, let's just be clear. We said this was a what kind of bar? That's correct. It was good. We said a seller bar. And we said that this was a buyer bar. And we said it's all about where it closed, whether it closed below the opening price or above the opening price. That told us whether it's a buyer or a seller bar. Okay, fine. What next? Well, let's have a look at what we call a low test bar. A low test bar is during the bar, the price is pulled down to the lows. It tests the extremities of the low. But then that low is rejected. Buyers then provide more support and push the price significantly up from its lows. And really what this bar is showing you that it was a failure to sell off in the bar. Does that make sense? So the bar tried to go down, and you saw that closing price try and go down, but then it failed. It pings back up. It's one of the most strongest signals you can have on a chart, on a price pattern in the Forex markets. Let's have a look at what it might look like. It could be either a red one or it could be a green one. It doesn't matter. It could be a seller's low test bar, or it could be a buyer's low test bar. This one, even though the bar itself is a seller bar, it is still considered bullish. What that means is that the bar opened here, it went up a bit, and then it fell. But then it pinged back. In other words, it left this long tail. And therefore we expect it to be bullish. What does that mean? Well, we expect what happens next to go up, correct. Now this bar here is what we call a buyer's low test bar. Notice the tail is considerably longer. Well, sorry, it's exactly the same size, but it's considerably longer than the rest of the bar. But the key is this bar is a buyer bar. But it's not the buyer bar that sends it up next. It's the tail. So what I want you to be aware of here is whether it's a seller bar, whether it's a buyer bar, it doesn't matter. What matters most is the fact that this bar went down, it fell low, and then it pinged off the extremities of the low, leaving this tail. And whether it's a seller bar or whether it's a buyer bar, what we expect next is for this to then rally. Practical. Over to you. Pick out the low test bars. Ring them. These are the bars where they've tested low and they've left a tail. And then notice what happens next. So look at the bars on this chart and look for the bars where there's a low test. Ring those bars. Okay, so look, what do we learn here? Okay, here's what we're learning. These little low test bars, where those bars kind of drop down, but they ping back up. Something happens next. What happens next? Market rallies. Market rallies. So what we're learning from this is when that market pulls back down, but then zips back up again within the same bar, it then causes this propensity for the market then to want to rally. Does that make sense? Do you see it on the chart? That's a low test. Let's have a look at a high test. It's the opposite. Bar's pushed up, but then it starts to drop from that high point and pulls right back, so leaving a tail at the top. So it looks like this. And the first one is most bearish because there's selling in the bar already. In other words, it's gone up and then it's dropped even lower than where it opened. This makes sense? So it's actually a seller high test bar. That's the most bearish. This is a buyer high test bar. It's still bearish. Do you see the difference? Obviously the difference is one's a buyer bar, one's a seller bar. But the key thing is this, they both have the tail at the top. See if you can find them. Okay. Right, so we see these high test points where the kind of market kind of jumps up and then drops back, and then we see that what happens next? It falls. So we're starting to learn about some little price patterns in price on the chart. Is this true? Yeah, and these patterns are important for us to be aware of because we're going to place some trades based on strategies, as we said, tomorrow. But we also want to make sure that we're intelligent and aware enough of other things on the chart which could otherwise screw up a trade. Does that make sense? So, for example, if I'm long and I have a high test, there's a good chance it could now drop. Is that true? If I'm short and I get a low test, there's a good chance it could now rally. So would it be useful to know this and understand this, to have this as part of our tool set, yes or no? Of course. Let's talk a little more about volume. We started talking about volume earlier on in the day. Volume, we said, is generally an indicator of professional trading activity. And what we also said was that volume, this is so much better. Volume is, thank you, this is so good now. Volume is, okay, so where am I? Yeah. Okay, so we said two things. We said volume is difficult to read because you never get a true imprint of it. Is that true? There's no central exchange. But we also said that. But we also said something about volume. We said, look, volume is generally an indication of professional trading activity, or certainly high volume, because there's certainly big guys who can really move in that kind of way. Here's the key: weakness in a chart appears on the buyer bar, and it must work like that. And the reason it must work like that is because big professional traders, big trading houses, the interbank market, trades with extremely large size, very, very big size, I mean hundreds of millions of dollars, and they must sell their positions into an up move in order to unload the positions without the pressure of really their own selling driving the price down too quickly. Does that make sense? And I want you to know that, because strength also appears on seller bars. It has to work like that. Again, for exactly the same reason. They have to then, offload their positions into that movement so they don't run the price up too quickly. Let's have a look at what that looks like on a chart. Notice here that we've got, there's volumes up and down all over the place. But the key is this. Here's the up movement, and here's volume really high. And what I want you to notice, you see this little bar here. This is the high test. Notice the buyer bar. The closing price is in the middle to the lower end of the bar, but it's an up bar. So what it really indicates to you is that somebody must be selling into this bar to cause it to drop lower. Does that make sense? And the only people that really can do that, or the only way to explain, how a big move upwards could then start closing into the middle bar, the only way to explain who that is it has to be professional trading activity. The retail trader we know is buying on the bullish move, and the only traders out there with enough size to sell into the up move has to be the professionals. Does that make sense? And so we can see that closing price start to fall towards the middle of that bar range. The volume tells us that there's a lot of trading activity out there, so it must be somebody big. And then what we can see is that following that, the price does what? The price falls. So what it really tells us is that a green up bar plus lots of volume actually goes down. And the red little bar with a fair amount of volume, the next move is actually up. But notice that the bar I'm looking at is a high test, isn't it? Does that make sense? So what you're really being aware of is because this has been higher in the bar and it's fallen back, so it's a nice high test bar under volume, you know that that move is likely to now start moving back down. Does that make sense? Because you're aware that this is a high test. And conversely, you're aware that this low test here, because it's under volume, and because it's got this low test movement, this part here on it, you know that that selling is pretty much over now, and it's now time to start moving in the opposite direction. That makes sense?
So the close need to be at least halfway within a length of the bar indicator?
Yeah, that's a good question. Where should the close really be? It's all relative to the size of the original bar, of the bar we're talking about in question, right? So if it's a small bar, there needs to be a tail on it where the close at least kind of halfway up. Do you know what I mean? Like it's crossed the halfway point. It's gone right down. It's at least crossed the halfway point on the close. Does that make sense? Let me kind of draw that rather than do it with my fingers. If this is the size of the bar, you want to make sure it's kind of gone past the halfway point, created the tail, and then back up here. Does that make sense? So you can see it's kind of dropped, it's tested low, and rather than staying low, let me draw this in the right colour. If, for example, we see this, well, this just tells us there's a lot of movement to the downside and it's staying down, so it's likely that it's going to continue like this. Probable. But when we start to see this, and then the close is here, but then a second or two later, we see this. This is what I want you to be aware of. Under volume, this part here tells us that whilst we've had a bit of selling here, and there can be volume maybe picking up, just like in the previous example, there's a bit of volume here, like here, but notice the low test, and this tells us that there's that buying activity in the bar. And the novice would still be going short here, or even entering short here. But this tells us it's all over. Does that make sense? So there's the low. So what I'm trying to get you drawn to is that your average stock trader would see a red bar, which is a seller bar, and volume, and would say, oh, hey, this is going to keep falling. What you've seen is that there is a low test here under volume. The likelihood now is it's going to literally flick to the other side. And it's an important signal for Forex traders. Does that make sense? It's a critical signal for Forex traders.
Does that normally happen on the next bar? Or
Yeah. It could be a couple of bars away, but generally it's the next bar. Generally we see a low test. You might see another bar sit kind of side by side, but then it should really turn around and get going. There are people who provide free charting software. You're aware of this, yeah? Let me tell you the problem with free charting software. It's free because nothing's free, right? So it's free because somebody sponsored it to be free. Does that make sense? So, for example, there's a really great piece of Forex charting software called MetaTrader. Have you heard of this? Yeah, and it's really good. I mean, in terms of the functionality of the application, it's really good. It's free too. It's really good. The data is just terrible. That's the problem. The quality of the data is just terrible because it's sponsored by one broker at a time. That's how they run it. So, for example, like Alpari or FXCM or one of their Forex brokers will sponsor the software for, say, they'll have a contract for, say, 3 or 4 months. So you download it, they give you their test data from that one brokerage, and you've got a nice little application you can use to see Forex data. Does that make sense? Problem is, you're seeing one view of the world. You're seeing one broker. The Forex market's massive. You understand what I mean? So you need to see, you have to see as clear the picture as possible. The difference, for example, in pivot points between what MetaTrader will give you and what Reuters or eSignal will give you is, can be 40 pips different. It can be 20, 30 pips different. So it's unusable. So it's okay to practice with free software, and get used to it. But then when you get serious about it, you want to make sure you've got something which gives you some good data. And data is important. When you're living off your trading account, it's your livelihood. You want to make sure that you've got the best data possible. True or false? True. It's one of those things you've got to do. So you've got a bit of volume with a high test. We expect it to go Up or down? Yeah, a bit of volume with a low test. We expect it to go up. Good. Okay, what are train tracks? Train tracks are a phenomenon to the futures in the Forex market. Most exclusively in the Forex market. It's essentially when we see the train tracks on the charts when we expect a big reaction and a reversal. We often see an overextended buyer bar at the highs, and then the next bar is an overextended seller bar as it closes at the lows. And obviously the vice versa of the scenario is also true. It's a reversal pattern and a crucial one because serious Forex traders use the pattern to exit trades as a big swing could be occurring against them. We often see this around, big news announcements. It's generally the pattern. And basically it just looks like this. It signifies that the move you're in is over, at least for the short term, and it's probably time to exit your trade. It's a good exiting or expect reversal of a trend type signal. I use it for educational purposes only here. You don't want to look to enter a trade off this. You're not going to enter any trades of any of the things I'm teaching you other than the 3 strategies. Does that make sense? That's it. It's just, you've got to be disciplined. But I want you to be aware of it. A lot of professional traders do trade this, although I don't want you to do that. But they will enter the trade as soon as the 5-minute reversal bar closes. They put a stop at the low or the high of the pattern, and they target basically twice the movement. So I'll show you what I mean by that. For example, they see this up movement here. Then here comes the train track. So 2 big bars next to each other within literally 1 time period apart. And they put a stop loss up here, and they go short. As soon as that bar closes, they're short here. And then this distance they're trying to do twice. So once, twice. See what I mean? Once, twice would be their target, closing the trade around here. That make sense? Yeah, you don't want to be doing that. So, I'm just showing you, but we're not going there. Yeah, it's just too advanced too early on. We want to make consistent money, yes or no? I've got to build your confidence. We've got to show profit in your trading account, otherwise you'll give up. It's a known certainty. True? That's true, let me tell you. So reversal bars, okay, look, what is a reversal bar? I'm teaching you some print, here's what I'm doing. I'm taking a stupid chart and I'm smashing it up into lots of little pieces, and then I'm kind of putting it back together again, but I'm just showing you what each of these little pieces means. Does that make sense? And then, it will formalize, I promise you this, it will formalize in your brain that when we put it all together tomorrow is really integration day. Integration with the strategies, and you'll be like, ping, this makes sense. Right now, what we've done is we've taken a chart and it's like got a rolling pin out, just like smashed it into little pieces, and we're just investigating each little piece. Does that make sense? Most people never do this. They never really have a complete picture. You'll have a complete picture tomorrow. So let me just go through reversal bar, what it is. Reversal bar, you want to call a reversal bar, and I'm teaching you some different language, so we're talking about buyer bars and seller bars and bullish and bearish moves and all that kind of stuff. Reversal bars are basically a series of seller bars are followed by a buyer bar, or vice versa. That's what you call a reversal bar. So sometimes you see a chart and it goes, green bar, red bar, green bar, red. It means nothing. It's just whatever, right? But if you see like green, 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 red, we treat that red as the reversal bar. Does that make sense? That's where we cook. Because there's a series of green bars, then you get a red one. And just on its own, it's not very powerful. But when you integrate it with the other things that we've been talking about, which I'm now going to do, it becomes more powerful. So what I mean by that, for example, look, here we have a bunch of green bars here, and then we have this red bar. And then what happens? It falls down. What else can you tell me about these bars up here? They're high tests, aren't they? They're actually kind of like trainee tracks as well, aren't they? Because they're kind of big bars next to each other, but they're really more high test. Does that make sense? What about what's going on here? Well, it's a series of green bars. Notice the high test and the real pullback, but it keeps going. There's still some buying in that market, but it's not really until that reversal bar comes in to then things start to move down. Does that make sense? Yeah. So what I want you to be aware of is when you see green, 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 red, that tells us that there's a good likelihood that things are changing. Does that make sense? So you've got what we call a reversal bar. Just on your own here, find the seller reversal bars. I want you to think, so you're learning some new language, find seller reversal bars. So you're looking for what kind of bars? What colour? Someone say yellow? What colour are you looking for? Yeah, we're looking for red bars, and they're following a bunch of green ones. So we're looking, find some seller reversal bars. Okay, so here's the key, look. All I want you to get used to is this. It runs, then you have a little reversal bar, notice it's a high test, it drops. It runs, reversal bar, then it drops. It runs, reversal bar, then we drop. Runs, high test, reversal bar, and then, do you guys see that? And there's going to be some reds and greens interplaced in between. But the point I want you to get to is, okay, so if we have a series of I want you to start to understand rhythm as it pertains to what these bars look like and what they look like in the parts of the cycle. It's not critical for your trading strategy. Your trading strategy will show you exactly what to do. You'll see that tomorrow. But I want you to be aware of what is going on whilst you're in the strategies themselves. Does that make sense? In other words, I don't want you just to be like dumb and blind and just only rely on the strategies. You will only be relying on the strategies to place your trades. But I want you to also be aware of what's happening in the bigger picture. Is that true? Yeah, and so I've cut to the chase on that. Find the buyer's reversal bars. We have the one here. Let's see if, and again we've done it nice and easy for you on here and here. So we notice that the buyer reversal bar here, some sellers, the buyer comes in, off we go. There's some sellers, buyer comes in, nice low test, and off we go. Do you get the principle? So this is important. So it's about having some buyer bars or some seller bars, and then that reversal bar changing things around and moving in a different direction. Let's look at then integrating that together. Let's see if I can integrate that a little bit. So, to give you an understanding of, as I said, I'm going to keep saying it, I'm going to teach you trading strategies tomorrow, but I want to give you just some core principles. Here's a core principle. Let's say I said to you, let's say you want to, let me just teach you how to trade anything. Do you want to learn how to trade anything? Okay, let me teach you how to trade anything. This can apply across any asset class. Doesn't matter. Let me just teach you something, just so you really understand price. So price, let me give you the perfect picture. I said to you guys, you don't trade the extension, you trade the pullback. Did I say that? Or I said the bounce, the pullback? Let me show you what that pullback would need to look like in any asset class. Does that make sense? Can I just give you like a generic how to make money trading long or short? Would that be useful? Okay. So let's do, this would be the ultimate picture. Actually, no, let me make you the ultimate picture. That's it. That's the ultimate picture. Okay, so what is this? Well, imagine that previous to this, we've got this, this trend, which has been bouncing along this thing, yeah? And here's our series of, what am I looking at here? Okay, well, let me just do some more. Okay, good. That's enough. So look, what's happening here? Let's take a look at this point. I said to you guys, we don't ever want to trade we only want to trade if we're buying. Let's say this is an uptrend. What do we need to see? First of all, have we got ourselves a low test? Yes or no? Yeah. Is it a low test bouncing off the trend? Good. Is this now a buyer reversal bar? Good. Does that buyer reversal bar take the high of that previous bar out? That would be an entry signal in any market, in any asset class at any time. Okay? That's how you trade. So you would buy here, okay? Where would your stop loss go? Your stop loss would go consistent outside of this line here, this black line. Okay? That would be a stop loss. Just write this down, saying how to trade anything. Okay? This is kind of integrating what I've talked about over the last 4 hours. And then notice what happens. You'll probably see some volume picking up. And you'll notice that you'll see these bars stretch. Yes? Yes or no? Yeah, and we said that there are phases, did we not? And this would be phase 2, this would be phase 1, this would be phase 2, and this would be phase 1. Yeah? And so all we're really looking to do, let's say we're just taking short-term trade and we want to take 30, 40 pips. Then as this, now notice this signal, you've got a seller bar here, you've got a buyer bar which takes out the high of the seller bar. That is a professional trade entry signal, yeah? It's a confirmational trade entry signal. You've also got a low test off the seller bar which tells you that there's already some movement moving in that direction. You've maybe got a little bit of volume starting to pick up, and then what you start to see, so now we're in the trade on this little bar here. By the way, this is not one of your trading strategies from tomorrow, just in case you're wondering. This is just a generic, how do I make money trade? Just I want to integrate all the things you've learned so you can kind of see how it fits. Does that make sense? Because we've broken it up first. Now I just want to stick it together in something. Now notice here, what's happening here? Well, are the bars starting to overextend? Yes or no? Yeah. Do we notice that there is the breathing is bringing about itself its own level of resistance? In other words, it breathes up, it's fully extending, and then we get this high test seller bar here in 2. Do you see this? And this for us is now a signal which says, okay, maybe it's time to collect profit. If our trading strategy was literally just to take the phase 1. Now we might have decided that actually we want to sit in this trade for another 3 weeks, and therefore we're targeting multiple trading cycles. We expect to sit in it for a lot longer. That makes sense? And if so, our stop loss would be a lot further down, and we'd be, having a smaller trade size, but looking to run it for a longer period of time. Is that true? Yeah. But here we're saying, look, my risk is limited just to down here. If this thing goes up a little bit and then bombs out, I'm out. But I'm already in an established trend movement upwards. My price, just to integrate everything that you've kind of gone through in the last little while, my price, the low test, tells me that it's about to bounce. The fact it's bouncing on an established trend, maybe even a moving average line down here, would that increase the performance, yes or no? What would be nice about the moving average line is it would also protect the stop loss, which would go underneath it. Would that be useful, yes or no? Yeah, and then of course the buyer reversal bar tells us it's a reversal, it's off a low test, which is already changing in another direction. So now we've got a nice strong confirmation entry into the trade. This is a series of then buyer bars which we're in, and then when it starts to overextend, let's say that period of time here is 30 minutes. And we know that the cycles have been lasting roughly 30 minutes before they pull back. Let's just say by example. Do you see what I'm saying? I'm just trying to give you an integration. Then and then we see the reversal bar come in off the high test. This would be our exit. Does that make sense? So we've got this little seller bar here, haven't we? And it's got its low test. And as soon as that's formed, right, we're literally going to stick an order just above here. So when it goes through here and it breaks through, we're in. Yeah? Yeah. And then, of course, the risk is like it literally could go up and then just dump. But given that it's sitting on a moving average line, sitting on a trend, it's already low tested. Key. It's already low tested and shown us that it tried to go down there and that was rejected. We feel that we are at the apex or the axis of the pullback. Does that make sense? And trading is about trading pullback. You never trade the extension. That's what amateur people do. We trade the pullback. So we get in here early, and this little black buyer bar here is hopefully a small bar. It's not overextended. Nice little just the market just starting, and it doesn't matter, we're entered in on the order, and our stop loss is often at the base of that low test, which is consistent with the trend and maybe just underneath that moving average line. Does that make sense? So that moving average, you want to make, we'll talk more tomorrow about, proper trading strategy, but I just wanted to integrate what you've learned so far so you can see where it fits. So what you should really see is an extension. In the ideal world, you'd see an extension of these bars growing in here, then they start to high test out a bit, and then they pull back to the trend. Does that make sense? We aren't buying in here, in here, in here, in here. It's all over. It's too late. We don't buy in here. It's way too late. We buy here, just at when the top of the apex is broken. And we're looking to exit where everyone else is looking to enter. Does that make sense? We just take the 30, 40 pips, yes? And then the confirmation of the exit would be, okay, then it starts to high test out and starts to fall back, yeah? Good question. How often do you just get like a consolidation rather than a bounce? It really depends if you've got it in a trend. If you've got it in a trend and it's established and you've got a good low test off it, the likelihood of it then breaking and running is good. Particularly in the currency markets, if you get, like I said before, just a standard consolidation like breakout, they don't work very well in the currency markets. And we'll talk about reasons for why that is a bit later on when we've got there. But the bounce along a trend, if it's a confirmational with a low test, which already shows you there's buyers in that market, even in the seller bar, and it's bouncing off an established trend line, then the likelihood of success in that trade once entered is pretty high. What you're learning now, this chart that I just drew and then graffitied, it could be a daily chart, right? So the bar that closes low, that low test, could be a daily chart. So you may sit there, put the order in, it doesn't even trigger for another 6 hours, and you're not even there. Or it could be a 5-minute chart, and it does it within 5 minutes, and you're done sort of 2 hours later. It doesn't really matter the time frame, but I'm just trying to integrate the principles that you all went into and just show you how they fit together. Does that make sense? Is that helpful? Yeah. And then tomorrow we'll do the real strategies. So you'll see, you've got the income generator, for example. I'll tell you now, 90% of you will trade income generators to start with. Some of you just won't want to trade end of day, you'll be intraday people, but most people will want to do end of day, and that's the income generator strategy. And that position you'll be in that trade between 3 and say 5 or 6 days. That's the average trade length. It'll take you, to start with, it'll take you half an hour to 45 minutes to put 3 or 4 trades on. And in 3 weeks' time, it'll take you like 8 minutes to put 6 on. Because you just be like, ta-ta-ta-ta-ta-ta, and it'll be done. And they will just play out over 3 to 5 days, and they yield like 300 to 500 pips of freaking amazing trades. And that's all you need to do. But then if you then, get really into it and you want to start doing more intraday stuff, then you'll start doing more intraday setups as well. And what we often find with people is income generators give you the exit from your employment. If you're employed and you want to get out of that and do something else, income generators are good trading strategy to get you out of employment. And then when you're out of employment, you've got nothing to do, then people tend to... Word of warning. Then you start kind of... Some people say, okay, I'm going to give this a little bit more time and I want to see if I can increase my pip value because their goals have then shifted on, they want to do other things. Some people don't. They just stay income generating and that's it, It really depends. I went through a period of time where I was trading, putting all my income generators on in the evening and some little pivotal setups in the morning. And then I was trading from home and I set this trading floor up at home. This is before all this madness started. It's funny how we're creatures of habit. And I just stayed at home and just traded and traded and traded and traded. And what we did some analysis because I'm really into looking at the numbers. And what we found is that I made all my money in the morning, and then I would lose about 30% of the day's winnings in the afternoon. And what was happening? I was just bored, and I just got into this pattern of sitting in front of the screen, just taking things on. So I was sharp as a dart in the morning. Because I just was trading my strategy in the afternoon. I was trying different things, a little bit bored, and all the rest of it. Does that make sense? And so I found that I had to, I was getting too big to even live in my house anymore because I put on so much weight. I didn't believe it. I was a bullfrog. And it was ridiculous. I mean, I just literally, if you sit in front of a screen and hit the fridge regularly, you won't believe how fat you get. It's unbelievable. If you don't move much and just fill your face full of food, man, you can dig your grave with your mouth in your teeth so quickly. So I just couldn't believe how big I was getting. And I realized I had to get away from the screen and do other things. So I just literally skinnied my trading time down to do it with like an hour, 2 hours, And that was kind of how I then started to develop the systems that I taught people. And it was a life-saving thing for me because, literally I would have probably died of a heart attack if I'd have sat there any longer. And I made so much more money by not sitting there just punting in the afternoon. Does that make sense too? That was amazing. It's like I'd give 30% of what I'd made just by screwing around in the afternoon. Still, I end up quite handsomely up. But boy, when you took away what I'd lost in the afternoon just by mucking around, and being more disciplined. And that's how then the system got generated for, when I just taught loads of people this. It's like, well, why do they need to sit there all day? It's just a stupid, it was this idea that one has to sit there all day because that's what you do when you work in a bank. You have to, you go there at 6 in the morning, you go home at 7 in the evening. You have to sit there all day. What are you going to do? Like flick paper clips? You've got to do something. So we used to just sit there, trade, and you just end up doing too much in the afternoon. Well, you can actually close things down. You're better off sitting on your hands than giving away the money you just earned. True or false? So then that's how I created the system, and that's what I taught people, and they got on with it. What I found a lot of people is they'll do income generator, and I would say probably 60-70% of them then go on and do a little bit more intraday because they just want to add a bit more. But I'll tell you now, most of you, 90%, will start income generating because it'll just work well with your lifestyle. You can manage. When you get used to this, you'll manage 5 or 6 positions like that. It's easy. It's easy. And the stop losses are in, and pretty much 90% of your stop losses are guaranteed by implication because it's the Forex market. And moving a stop loss on day 3 on an income generator is like it's child's play. It's easy. It's easy. But what you're understanding right now is very important in terms of the breathing of the market, understanding the high test, the low test, the whole bit that we just did, that little skit. With the seller bars, with the reversal bar, with the low test bouncing. Do you see why that makes it quite a high probable entry from what we've talked about today? Yes or no? No, that's good. That's good. So the question was, how does gold? And it said, why haven't I discussed this? The reason is, the question is, when gold goes up, does the dollar fall? Is that it's kind of like that, isn't it? You're talking about intermarket analysis, aren't you? The relationship of other asset classes and markets to currencies. And the point is, when people, we generally use what we call the gold standard, or the price of gold to give us the likely, or as a gauge to the direction of what's going to happen to the US dollar. In other words, when people buy the US dollar, they think it's going to rally and it's a big, strong economy, and it's going to keep running, and they sell gold. And when people are buying gold, it tends to be because they're freaked out about what they think is going to happen next to the dollar, so they buy like this non-yielding asset gold as security, right? That's normally how it works. But that's not always true. That's not always true. And people get fixated on gold and the dollar. And often there are periods of time when gold rallies, dollar rallies. But it's the dollar rallying against other currencies. So in other words, other things can be going on with other currencies as well. Do you see what I mean? So the reason I don't introduce it here is because when we're trading currencies, we are trading one currency, say the dollar, against the euro. So I specifically want us to be focused on the relationship between those currencies. And most of that work can be done just by looking at the chart, rather than get people into a mindset of being, they're dollar bears and gold bulls. Do you see what I mean? Because it's always, with currency trading, it's relative to what? For example, relative to sterling. Well, sterling, for example, last year, people were certainly buying gold, which would suggest a drop in the dollar. But then when you compare the dollar against the British pound was falling faster than the dollar. Hence why we had that 6,000 pip fall. Does that make sense? So the reason I don't integrate gold with it is because it's relevant to the US dollar, absolutely, but it's not relevant when you look purely at one currency against the other, or not as relevant. Does that make sense? Yeah. So at the end of the day, I try and remove stuff than add, even though it looks like I've added quite a lot today. I'm trying to give much bare bones as possible. Does that make sense? But having said that, today, do you guys feel like we've covered quite a lot of ground, yes or no? Yeah, and we have actually covered a hell of a lot of ground. But we have to cover that ground. We had to cover that ground. We had to go there. Does that make sense? And when you really consider the amount of, what we've covered in terms of news, I could give a 6-month economic lecture just on understanding economic news. Is that true? Oh God, we haven't even touched the surface of how to interpret news, have we? We've done what's important, which is tell you don't get in there when big news is coming in. Does that make sense? And to show you the impact of news with a technical direction. And that is enough. We don't need to go there, because the more we get into that, the less we're trading and making money. Does that make sense? I've worked on so many different trading firms. I'll tell you now, the economists in the room are not the guys making the money. They're the guys trying to figure out what just happened. And then predict something that's going to happen that they get wrong. But the guys that are trading are simply looking at trading strategies, are not putting themselves at risk when the news is out there, because there's just too much news now, isn't there? I mean, the whole news industry is just gigantic. So rather than us kind of get embroiled in the news and try and understand it at that level, what we've got to do is we've got to say, look, when there's big news out there, we just don't need to be in the market. Our job is to make money as private traders. And people will say to me, how come, private traders make money, but a lot of bank traders don't? Do you think that's interesting? Here's my answer for that. If you're a private trader and you don't make money, it's relatively Darwinian. You have to go get a job. Do you know what I mean? But if you're a bank trader and you don't make money, dude, you've got a job for life. Does that make sense? Because you're in the framework of an investment bank. They'll never get rid of you. They'll just keep hedging your position. You'll be there for life. So private traders, we just take a discretionary approach. We just use trading strategies. We are not bound by any particular regulatory body that manages the fund which we operate under. We just trade our own positions. And as long as we stick to strategies, as long as we don't get ourselves embroiled when there's big news announcements out there, we can steadily pull money out of the market. Does that make sense to people, yes or no? And so all we're really doing is we're just modeling what private traders do who trade for a living. And our goal is to keep our targets front and center, keep ourselves out of risk territory, and use strategies that work. And if we do those three things, we're going to make money. We're going to make money trading. If we go off the path and start getting into creativity and variety, we'll come unstuck. Does that make sense? So what I want to get across as a message is that trading should be, as an activity, relatively mundane, relatively boring, relatively consistent. It's just that the pip value should increase over time. Does that make sense? So what a lot of people do is they enter trading because what they're currently doing they're kind of bored of. So they want to just, they want to try a bit of trading because, they're bored of what they're currently doing anyway. Well, trading should just be a vehicle to make some extra money. I think you should get your variety from somewhere else. Do you know what I mean? Because a lot of people go to trade and they want to get their variety in it. So that as soon as they've done one course, before they even put the stuff into practice and tried it, they're at another flipping course trying something else. Does that make sense? They're just like, they're just like variety people. So they just want to just try. And my take to you is this: look, you've got to test this out for 6 months minimum, right? To get the benefit. From it, and then you won't need to do anything else. You'll just, one of those three strategies is good likelihood that income generating is going to be a big part of what you do, because we know that one strategy is the one that's primarily responsible for allowing people to never have work again, never need to work again. And that's the one that's just nice and consistent. It pulls big pips. You'll find the stop loss is a long way from the entry price, which means that the likelihood of you getting stopped out is minimal. You'll see the trade entry. When you learn it tomorrow, you'll be like, God, I understand why that works. You'll see why that works from what you've learned today. And then when you look at it across charts and you see like the evidence of what it does, you'll be enthused and you'll want to get stuck in. And then we have to trade with you and get you going. Does that make sense? Cool. How are we doing? You okay? Are you good? I want to do MACD. Can I just get into that? Yeah, I want to get into that. Let me get into MACD, because if I get into MACD, I feel like I've really broken the back of where I want to be. So look. MACD is an indicator, okay? How many of you know what an indicator is? How many of you don't know what an indicator is? Okay, what indicators are is the folk who make trading software, they use some of the data and they apply some mathematic formula to it, and they create little signals based off the data to try and give you some clarity that just looking at the raw price data doesn't. Does that make sense? And there's this one indicator which is very popular in the trading world, has been across all asset classes, and it's called MACD, and it stands for the Moving Average Convergence Divergence Indicator. And what it does is it really gives you an understanding. It gives you an understanding of whether a market is kind of, overbought or oversold. That's what it kind of does. It kind of gives you an understanding of what the trend of price activity is doing without kind of getting caught up with all the fuzziness of the price movement. And as I said to you in foreign exchange trading, what we're doing here is we don't really look at MACD. Let me just kind of jump to a chart. It might make it a bit simple, a bit easier. Okay, so this is there we are. This is a chart of British pound. I'm back. Now, right now, all we've got on this chart is the 50 and the 200. True? Yeah. All I'm going to do now is I'm going to drop an indicator on here, and it's the MACD one. And all I want to do is, there we are. So it's right in front of my eyeballs. So let's just, okay, so look. There's a blue line, there's a red line, there's a load of purple bars. All that indicator does is it compares slightly longer time, average of time price over a slightly shorter period of time price. Does that make sense? So it has a control, which in this case is 9 periods. So the control line is the average of over 9 days, right? And it's just a nice little line. And then it compares the difference between 26 days and 12, and it creates the second line. And the idea is, if you were a stock trader, when this little blue line here breaks up through the red line, I'm going to see my crosshairs are on that? Yeah, we would use that as a buy signal. So we buy it here, right? And then when the blue line crosses back down through the red line, we sell it. Does that make sense? Yeah. And then, so then we sell it here. And then we buy it again when it goes here. And then when it crosses back down, we sell it here. And that looks like that works quite well, doesn't it? Is or no? Yeah, it's terrible, the signal. It doesn't really work. I mean, it looks like it works well, but it doesn't really work that well. Because it's lagging. It's a lagging indicator. And we just don't, in stock, very amateur stock traders use it and blah, blah, blah. But we don't really use that in currency trading. That's not what we use to enter trades. Does that make sense? We just don't use it to enter trades. The way we use it in the currency world is we look at the trend of the actual MACD itself, okay? So rather than these crossing of lines that I'm looking at here, we don't do that in the Forex world. Let's look at how we use it in the Forex world, because this is good. Now, divergence means disagreement. Convergence means agreement. We look for divergence between MACD and the price action to identify a turning point. In other words, if the price is moving up, but then the MACD starts to slope down, we start to think, hold on, that currency pair could be moving down pretty soon. Does that make sense? The MACD itself should copycat the price action. And if they're in convergence, we continue buying, or we continue selling, depending on what the trend direction is. However, if the pattern is not repeated and the MACD is kind of sloping downwards and price is still moving upwards, there is definitely weakness in that chart. Now, your eyes can't see the weakness in that chart because your eyes can't look at the pricing data, figure out the calculation of where the closing prices are on each individual bar, add it all up and sum it whilst you're looking at that chart. It's just impossible. That's why a MACD indicator is useful, because it takes into account where those prices are actually finishing, not just the trend of the bars. Does that make sense? And it gives you an indication as to whether things are moving off. So it's this divergence which allows us to see whether things are going to change on that chart. So let's have a look at what we call bullish MACD divergence. So here we see price falling. Here we see price falling, but at the same time we see MACD, which is getting what? Higher lows. Do you see the lows are getting higher on MACD? And what we would expect from that, we'd expect a strong movement upwards. So let's have a look at what this looks like on a chart. Notice here, look. What's happening to price? It's down. What's happening to MACD? Going up. What happens to price? Then it goes up. So what we notice is that when there's a divergence, is there a divergence here, yes or no? There's a clear divergence. When there's a clear divergence like this, we expect that price will then turn around. And in fact it does. Okay? So if we were then, how would we use it? Well, if we were then going to trade, if we were short and we started to see that the MACD price started to move back up, we'd look to not either take the short positions on because the MACD would be telling us this is going to rally soon, or if we're in a trade, we look to close it down. Does that make sense, people? Yes or no? Yeah. So that's bullish MACD divergence. Here's some more examples. Notice how the price declines, forms a double bottom. This is where it bounces like this and forms this double bottom. Fails to make It fails to make this double bottom. It's now rising, giving notice of a change in momentum, and shortly after the price rallies back up to the 200. So here we see the low, and the low. So here's our trend, upwards. Here's price moving downwards, and then price turns around and rallies up to the 200. Let's take a look at another example. Here is MACD again, falling. Sorry, price, thank you. Here are the lows, putting in higher lows. What happens? Price turns around. This is, in terms of currency traders, this is the strongest secret signal of all. Please write this down, this is the strongest secret signal of all. You can always tell somebody who trades foreign exchange and somebody who doesn't, they either use MACD divergence or they don't. Because this signal will tell you when that market is turning around. Remember, your job always is to do what? Remove risk. And if you've got a MACD line which is moving in the opposite direction, you know price is going to turn around. Price is going to turn around at some point soon. This is bearish MACD divergence. Here you've got price. Notice the highs. Price is making higher highs. What is happening with MACD? It's making lower highs. They are divergence. They're in disagreement with each other. We'd expect a strong movement downwards. Let's take a look. So here we see, look, nice classic example. This is Euro's 15-minute chart. Here it's running up, nice higher high points. What's MACD doing at the same time? It's making the lows. Price makes new highs. Check out MACD. It makes lower high. We have bearish divergence. The price subsequently drops 120 pips. It doesn't matter what the time frame of reference is. If I'm trading the 15-minute chart and I have bearish divergence, a MACD bearish divergence on that 15-minute chart, that would be the central chart I'd be trading, right? So I would be not looking to place that trade. If I'm trading on the daily chart, okay, and the daily chart is in an uptrend, but I've got bearish MACD divergence, okay, from a daily chart perspective as the central time frame of reference, I'm not going to be looking to continue long positions on there because I know it's going to come off pretty soon. But I might be on the 15-minute chart. If there's no bearish MACD divergence yet on the 15-minute chart, might I still be placing longs, yes or no? Yeah, of course. So it's relative always to the time frame of reference that I'm trading. Does that make sense, people? Yes or no? So it might not have happened yet. It might not have happened yet. It might, we'll soon see when it starts to happen. It will change across those 15-minute charts in a heartbeat. But if it's not happening on those 15-minute charts yet, we know it's not happening yet. Does that make sense? So it's always relative to the time frame reference that we're trading. In this particular example, it's a 15-minute chart. Notice here, another example. Notice the higher high. Notice what's happening on the MACD. Price makes new highs. Check out MACD. Makes a lower high. It drops another 140 points. When you see a market making higher highs, and the divergence is making, say, for example, lower lows, you don't know it's not an entry signal. Okay, it's just telling you to keep out. Does that make sense to everybody? In other words, it could go higher again and the MACD could go lower. So it's not an entry signal for a trade. It's a warning to keep you out of the trade because there is going to be an imminent move to the other side. That's the message. Does that make sense? So you just keep out of that market. That's the key. This is a warning signal. It's not an entry signal. A lot of this stuff, it's very difficult to appreciate the value of it till you're in the arena. We'll get you in the arena, don't worry. Okay, and price cyclicity. We've started to talk about, I'm going to declare price cyclicity. I'm going to do price cyclicity tomorrow. Are you guys good? Are you having fun? Yes. Ooh, you've been good. We're making good progress, so I'm happy with where we are. Where we sit right now is we're kind of at the halfway point. How are you guys doing? We've done environment, right? You haven't learned to trade yet. So don't think you've learned how to make a bean yet. You haven't learned how to make any money yet, okay? Trading strategy is about how to make money. So tomorrow, we're going to hit cyclicity, patterns, and then we're going to get into the whole risk management piece, and then we're just going to nail the strategies. We'll do a bit of psychology, but tomorrow it's really about making sure that you are 100% with those strategies. We'll practice them, and then we're going to get you out there in the field, and you're going to start putting this into practice, start making some money. Is that good, or is that good? Yes. No, it's good. Okay, it's been a great day. We'll see you tomorrow morning, bright and breezy, 9 o'clock. Thank you very much. Woohoo!